The Wealthy Life is brought to you by investment dealer Raymond Jmes. Life well planned. See what a Raymond Jmes advisor can do for you.
We're back. With us today is Lori Pinkowski, a portfolio manager who sees the mistakes investors often make and helps them avoid major blunders. Well, that puts a lot of pressure on you as a portfolio manager. What do you do to blow off steam outside of work?
Well, I go to the racetrack often. I have my professional racing license, so I do that for fun.
Wow, how did that come to be?
It came to be, I don't know, I have German background, driving on the Autobahn when I was younger, and when you learn how to drive on a track, you always have to be prepared for what's around that next corner, and for me, it actually translates into what I do on a day-to-day basis. You have to have a plan, you have to be disciplined. When you're driving 250 kilometers an hour, you got to know what you're doing.
Wow. And so risk management in both daytime and after hours, it's the same scenario.
It's exactly the same.
So what are some of the common mistakes that you see investors make?
Well, I think one of the main ones that I often see is when, a new client comes to the office and, they show us their statements and they've got stocks that are down significantly in their portfolio.
Yeah.
And, they want to hold on to those stocks and they want them to come back. And I think that's one of the major mistakes I see, holding on to your losers.
Yeah, you got to cut your losses and move on. Why is it that people hold on to their losers or want to hold on to them?
I think a lot of it's ego, actually. I think a lot of people don't want to believe that they've chosen, the wrong stock in the portfolio, or also just they're hopeful. People want to be hopeful. They want to be positive. That stock's going to come back, and often it never comes back, or it could take 5 years for that stock to come back. I mean, you just think of a stock like Nortel, and how many times have you seen that in someone's portfolio still? That should be a reminder. You definitely want to cut your losses when you can.
Get rid of it. Well, Nortel, when it reached its peak around $121, $122 and then pretty much disappeared, but you're still looking at that Nortel in the statements, this defunct security. Not fun.
Exactly.
Get rid of it.
Yep.
I don't understand why people would like to have those reminders in front of them. But maybe also when stocks get to such a low that people feel, well, what's the point of selling? I might as well hold it. But it's just good to clear the head and move forward.
Well, you always want to have a plan because you're never going to pick 100% correct positions for your portfolio, right?
No.
So what you want to do is you want to hold on to your winners and sell your losers. And I just find that so many people do the opposite, right? Because when you sell a stock that's up, it makes you feel good inside. It even makes the financial advisor feel good inside that they're calling their client up, say, you should sell this, you're up 20%. But they should be calling you and saying, this stock is down 10%, you need to sell it. That's what a good financial advisor should be doing.
Yeah, and I think you can win by not losing. So if you ride your winners and limit your losses, those two together is a winning formula.
Very much so.
What's another common mistake you see people make?
I think another one would be putting too much emphasis on fees. Fees are, obviously a hot topic in our industry. And, I've been a big advocate of transparency of fees. And as you know, CRM2 is coming into our industry. And it's very important that one knows how much they're paying. But I also believe when you're looking for a financial advisor and you're interviewing, you should be asking, what is your returns been net of fees, so after fees. You want to ask them, are there any hidden fees that you don't know about? But don't say no to an investment just because it has a fee, because everything usually does. Yes. As long as you know what the net return after, or what the performance has been after that fee, and then make your decision based on that. And you want to also watch out for just investing in things that just have low fees, such as exchange-traded funds, ETFs, as you know, index funds. I mean, they can be a great investment tool, but just, sitting on them and holding on to them in a market downturn would not be a good idea either.
No, and it can underperform some of the actively managed portfolios, such as the ones that you run. So people need to be careful. You get what you pay for sometimes. Everyone's conscious about fees, and me included, and I'm sure you as well. You want to get the best bang for buck. But in order to get the best bang for buck, you need to look at the full picture. What services are you getting, and what is your net return after fees?
Exactly. You want to know all the answers before you sign up with any financial advisor.
Now, you mentioned CRM, and most of our viewers won't know what CRM is, and I'm not even going to explain it. I'm going to suggest that our viewers ask their financial professional what CRM means, because that's part of the discussion. regulation. Essentially, it's regulation about full disclosure, but it's a good conversation piece for clients to have with their advisor.
It is. Finally, like I say, I'm on CKNW. I have a show there. I talk about fees all the time and transparency of fees. And finally, with this new regulation, basically, finally, investors are going to be able to see how much they're paying, in mutual funds. And mutual funds, as we all know, have a lot of hidden fees that are not disclosed. And finally, in Canada, the regulators are finally saying, we've had enough. Investors deserve to know what they pay, and I 100% support that.
Great. Just don't make a final decision based on the fee number itself. Look at the big picture.
Exactly. Look at the performance.
Another common mistake you see people make.
Well, I'd say the herd mentality. We see a lot of that. If your sister, your mother, your neighbor is buying a certain position or investing in a certain sector, you can think, gold bubble. You can think of energy bubbling up. Or
have I got a hot stock tip for you? Or,
exactly,
yes.
Exactly. And the tech bubble is probably one of the greatest bubbles that we've seen. And Nortel, as we mentioned earlier, and I did have a client come in last week, a new client, and he said he keeps Nortel on his statement actually, just to remind him not to get too involved in the decision making, because again, that was the herd mentality. His financial advisor didn't even tell him to buy Nortel. He decided to buy it himself.
Wow.
Yeah.
So, having a contrarian view sometimes works out better. Don't just go in blindly and do what everyone else is doing. It may not be right for you.
Yeah, it may not be right for you at all. Yeah. And it might be really bad timing, because if everybody's telling you to do something, usually you should be doing the opposite.
Good advice.
Yeah.
Now, how about when people get too involved in the micromanaging of their affairs?
Yeah, that's another one. Our majority of clients do not follow the stock market, right? I'd say 95% of them, that deal with our team, and that's why we're portfolio managers. So we make all the day-to-day decisions for them.
Yes.
But as for a financial advisor, when they're dealing with clients one-on-one, what to buy, what to sell,
yeah.
Sometimes, I think that investors get too involved in trying to tell the financial advisor what they should be buying and selling, or when. And, unless you've been in the investment industry, then you may be a little bit too emotional sometimes. And
why are you hiring a professional if you're just going to do it yourself?
Well, yeah.
And generally, the results aren't great. Do you have a final point or a mistake that investors make?
Having no proper risk management on their portfolio, I think, is the biggest mistake I see. My belief is that buy and hold does not work in today's markets. We have a lot of volatility. You need to be proactive and have discipline in order to get out of the market if risk is coming your way. And that would be the mistake I see the most, is that a lot of financial advisors say, or even investors, just kid themselves into thinking that things will just go back to the way they were. Often stocks, sectors, positions don't. And so you need to make changes and have proper risk management and discipline before that happens.
Well, thanks, Lori. Hopefully our viewers will take a lot of those tips seriously and not make the same mistakes that other people have made in the past. When we return, learn the secret formula to evaluating a rental property so you can make the most of what you have.